This is Professor Melanie Hildebrandt. In this video, I'm going to discuss what really is for this class the beginning of our macroeconomics that we're going to cover. Really everything we've covered up until this point is just basic economic principles that we use in both macro and micro courses. So in this video, I'm going to introduce to you the aggregate demand, aggregate supply model. And really this just builds off of demand and supply that we covered in a previous chapter. So let's start with the demand side of our macroeconomy. So we're talking about total output. So you'll hear this referred to as aggregate demand or aggregate output, real GDP. Those terms are all kind of used interchangeably, okay? But this is the total demand for all goods and services and that we were wanting to purchase during a given time period. And it's based on, or it's related to what we call our price level. And the price level is a kind of aggregate measure, a composite measure of the general prices in our economy. You know, think back when we were talking about supply and demand, we would just look at one market, right? The market for pizza. If the pizzas are $10, the consumers want to buy 100 pizzas a week, okay? Well, now we're talking about the demand for every good and service by households, firms, the government, the rest of the world, okay? All of those key economic players that we've already discussed. So now we need a measure of price, but every good and service has a different price. And so that's where we come up with this index that we call the price level, okay? So it's going to reflect the average prices of everything that's produced and then bought in our economy during a year. It's always 100 in the base year, and the base year can be different years, but we use the base year comparison so that we can then measure how much have prices changed over time, and that'll be discussed in further videos. Real GDP, so the qualifying word real here means that it's output, an output measure that's been adjusted for inflation, for changes in price, okay? And so if we're talking real GDP, it's truly showing what did we produce this year. If you hear someone say nominal GDP, nominal means it's expressed in current year dollars, and so it has not been adjusted for changes in price. And this is what our aggregate demand curve looks like, okay? Again, just like regular demand, it's downward sloping, showing that there is an inverse relationship between our price level, which again, like price, resides here on the vertical axis, and then our output, like quantity did in previous chapters, is down here on the horizontal axis. Again, we're calling this real GDP. So let's talk about the other side of our macroeconomy, aggregate supply. So now we have total output that's supplied by all firms for all goods and services. It's represented graphically by our aggregate supply curve. And now we're going to see a positive relationship, just like we did for regular supply, meaning that as the price level increases, firms are willing and able to produce greater quantities of their goods and services, okay? We do assume that a few things are constant along the curve: the resource prices that firms face, their states of technology, and the rules of the game. And again, I already mentioned it's upward sloping. So once we put the two together, this is a picture of our macroeconomy. This was an example from 2014. And so in this economy in 2014, our total production was $16.1 trillion worth of goods and services, and our price level for that year was 108.3. Now notice over here on the side, it says that in 2009 it equaled 100. What does that mean? It means that for this graph, we're using 2009 as the base year. And so again, in the base year, the price index is always 100. You'll see why later in a later video where we talk about how to calculate a price index. But so in 2009, it was 100. Here we are in 2014, and now it's 108.3. So this means that prices of goods and service on average have increased 8.3% since the base year of 2009. And I have a second video linked in this chapter that I think I call it like percent change calculation video. And so that will show you how I calculated here that rate of inflation. Okay. So here's just another example. This was in aggregate demand and supply in 2009. And so here you can see the base year is different. Again, I'm just trying to show you that you can have different years as your base year, but whatever your base year is, the index in that year will always be 100. And so here we see the price level is 110.7 in 2009. And so that means prices were 10.7% higher than the 2005 prices. So from the previous graphs, we saw what it looked like when our economy was in equilibrium. Well, if you remember anything from our chapter on supply and demand, the economy is not necessarily going to stay in equilibrium. Things might change and we have a new equilibrium. So what if we have a change in aggregate demand? This would be caused by just a change in a spending pattern by one of our groups. So it could be an increase in or decrease in consumption spending by households, a change in investment spending by firms, a change in government purchases, or a change in net exports, either because imports or exports or both are changing, okay? And so just like with regular demand, we're going to illustrate this on our graph by a shift of the aggregate demand curve. So if aggregate demand increases, it shifts to the right. This would result in a higher price level and higher output. If aggregate demand decreases, it would shift to the left, and that would result in a lower price level and lower output. And so here's an example. And this is an actual example from our macroeconomy. This was a change in aggregate demand from the time period of 1929 to 1933. Hopefully we all recognize this time period. It's called the Great Depression. And so the Great Depression was characterized by a decrease in aggregate demand. And so we saw a leftward shift of our aggregate demand curve. Again, what did this cause? Well, it caused our price level to drop, and it caused output to drop as well. Another example from our U.S. macroeconomy would be in the 1970s. So in the 1970s, our change was different. It was not the demand side of our macroeconomy, but it was supply. And so just like it did with regular supply, an increase in aggregate supply is a shift to the right, a decrease is a shift to the left. So take a look at our curves here. As we move from this darker red aggregate supply curve in 1973 to this kind of coral line in 1975, so that's obviously a decrease, right? A decrease in aggregate supply over a 2-year span. Just really quick, the decrease was caused by some production disruptions due to worldwide crop failures, and then also this is when the OPEC oil embargo was happening, and so the increase in gas prices caused a decrease in supply for most firms. So what happens to equilibrium when there's a decrease in aggregate supply? Well, we see that output declined, okay? Down here on our real GDP bar, we see output decline. At the same time, price increased. So we call that stagflation. You'll see that word up here, stagflation. So stagflation is when we have stagnant or reduction in production and inflation or an increase in prices. So make sure you know that word, stagflation.